Hey folks, it's Rob Flux here with another Sunday session, and today we're going to be talking all about asset protection versus tax minimization. Just notice my collar's looking pretty terrible. That's really bad. And why the difference? Because a dollar you earn and a dollar you keep are not always the same thing. And when you go out there to get advice, you're going to get some very different advice when you talk to your accountant versus when you're going to talk to your solicitor. So in order to have this conversation, I'm going to see if we can start a fight and have a debate with an accountant, Jeremy Iannuzzelli from KHI Partners. Mate, you represent the tax minimization side of things, but we're going to also, I guess, kind of challenge some of that with regards to the asset protection side of things. So firstly, welcome aboard, mate.
Mate, thank you very much, Rob. And it's always a boxing glove match, 3 rounds between solicitors and accountants of which one will take the honours of getting the 10 points from the judges. But they do sometimes not, they're not cohesive. They don't work hand in hand. Solicitors and accountants will have different ideas, and it's just a matter of making sure which one is more applicable to you in your certain situation. So I'm looking forward to unhashing a lot of that and really going down the rabbit hole with you today to educate a lot of people listening about tax minimization and structures, and especially how it's used for creating wealth around your developments and other things you do in your life.
Yeah, well, today it is going to be an unfair fight, mate. There's only one side represented, so you should be in good hands. And I'll try to go as gentle as humanly possible. And clearly, in all things like this, I guess this is educational in nature. Please don't constitute this as advice. Mate, let's talk about asset protection versus tax minimization firstly. So from an asset protection perspective, when we're talking property development, we do a lot of things that expose us to, I guess, the potential for being sued. Okay, so we're building structures that have ongoing warranty obligations. The structures themselves, the foundations could leak, the roof could, foundations could sink, the roof could leak, the quality of the workmanship could be poor. All sorts of things could happen, and a lot of people out there from an uneducated perspective think, well, it's all the builder's responsibility. But what people forget is actually it's the developer's responsibility, because the developer was the one who caused the builder to do the work and chose the quality of the builder, and hence the quality of the workmanship that was actually done. And they're also the one who sold the product and represented the product as I guess a quality product in the first place. And so the ultimate buyer will come to the developer first from an asset protection perspective and go, hey, you sold me something that doesn't work. The developer then has to then go and approach the builder, and the builder does have an obligation, but the obligation is through the developer first. And people, I think, forget that chain of command. And so what we want to try and talk about today is how do we, I guess, respect that chain of command, but also get the tax minimization out of things.
Yeah, absolutely. And especially now what we're seeing, and I think it's on everybody's social media feeds, about builders going bust left, right and centre. I think by last count, ASIC had recorded just in the year of FY23 alone over 2,000 building firms going bust, ranges from obviously mum and dad builders all the way up to your large national builders. So it is important. It's one of those major things that you need to consider, that the person who is doing your job today may not be around to warranty these particular provisions, and an individual that is bought the product from you, because in the end, when we're developing properties, we're providing a product for the market, and in exchange for that product, they give us money. They're going to go after the person who sold them that product. And then it's up to us through our entities potentially to counter-sue and go down that funnel, which has a big catchment and a very small circle at the bottom. So it becomes a spinning spiral of death for many people. And it's not because of the right or wrongs that they've done. It's the money involved to get yourself out of those issues.
Yeah, so, and there's a whole bunch of remedies that are out there with regards to home warranty insurances and things like that. But there are conditions and provisions that apply as to how and when that actually, I guess, kicks in. And also, you as the developer, if you're going to keep some stock, you want to be able to cash in on those home warranty insurance things as well. And if you don't get your structures correct, then that might be an issue for you to actually claim insurance against your own thing. Now, I can speak from personal experience here. I did an 8 townhouse project. I kept one project, one entity out of that one asset, I should say, and that is only one where the roof leaks. And I've had ongoing issues and warranty issues with that. And I am unable to make a claim against the builder because they went broke. And I'm unable to make a claim against the homeowner's warranty insurance because I was the developer. And because at that time, that was project number one for me. That was when I learned the hard lessons that we're going to talk about today about getting that entity structuring correct right up front.
Yeah, so I think a lot of people need to understand when we talk about asset protection as accountants or solicitors, or we talk about it just general with our friends and family, it's understanding what investment entity that we're using or what vehicle we're using. And there's lots of people, have connotations around SPVs, or otherwise known as special purpose vehicles, companies, trusts. It's just creating a layer of separation between you and the actual entity that owns the particular development itself or investment. And it's so important that you make sure you understand the intention. And I suppose we'll get to that a little bit later on. But what you're aiming to do, your first and foremost, is always how we can protect that asset in the most feasible way. And then we start to look at tax minimization later on. But it's what comes first, Rob. And it's always tricky. Do we spend a lot of money on asset protection, or do we utilize those funds to focus on our development and maybe get some form of tax minimization techniques involved at an earlier stage? But anyone who's out there that's developing, you'll always need to consider that you're dealing with large numbers, you're dealing with big products, and often there'll always be some issues, some minor and some major. And you've got to have at least 3/4 of your eyes set on asset protection and the right structure to ensure that what you're doing, you're keeping a majority of that money in your pocket and it's not going out to solicitors and I suppose other claimants as well.
Yeah, well, so we touched a lot on the asset protection side of things, but tax minimization, mate, if we've got the right structures, we can determine when money can, I guess, be distributed. We can choose where it actually gets distributed. We can be very flexible in giving it to people or entities on lower tax brackets than we might actually be. So we're able to, I guess, improve how much of that dollar we earn versus how much dollar we keep, just by creating some very, I guess, flexible structures.
Yeah, well, accountants work with the frame of mind that a dollar saved is a dollar earned. That's my role. My role is to make sure that you understand that tax is a cost and a function of developing. And the more money that we can keep after tax, the more capital that you've got to inject in your next development or your next investment. So with the right structure in mind, again, along with the intention, the business plan of what you're doing, if we can save, clients anywhere between 10, 15, 17, sometimes upwards of 22%, with inside the right structure, that's giving you as an individual more capital to move forward, to be able to then inject in future profit-making enterprises. So the dollar saved, dollar earned mentality, you need to make sure that you're keeping, again, most of your eyes and mind on that, because it's what's going to give you an opportunity to continue to progress moving forward. And that comes with having, again, the right structure, the right tax minimization techniques involved, and a hybrid of those structures together to be able to get the best outcome for yourself. And sometimes, as I said, it can be anywhere between 10 and upwards of 22% in the dollar. And over a couple of $100,000, that's over $40,000 in most circumstances staying in your back pocket, which could be the difference of you moving forward in the next deal.
Yeah, and because there are many different places that tax can apply, so it can apply to you, the individual. It can apply, I guess, to the entity that you're actually starting to do it in. It can be the entity that it's doing it in and then distributed down to you. How and where we actually put all this, you touched on this before, hybrid structures. It's not just putting a single structure in place, but many different entities sometimes to actually get the best of both worlds and blend that asset protection and tax minimization. And now that can be extremely daunting for some people because there's a super complicated mechanism. But when we break it down, the actual elements themselves are actually relatively simple to understand. It's then just how do we put them together? And I like to think of them like Lego bricks, where you can build an 800-pound gorilla, or you can build the Eiffel Tower, or you can build a little racing car. It's really what's your intention with regards to I guess, what you want to do. And then when you know what your intention is, both short term and long term. So what are you doing for this one particular project? And what are you wanting to do over the next 5 to 10 years, and actually start to build into that final thing?
Yeah, I think the reference you made to Lego is fantastic, because it's something that we can all understand. We've all seen it and played with it as even adults. I'm playing with it with my young children, but starting with the end in mind is quite important. And when you buy that box of Lego, you have that picture, and it's a matter of putting the blocks together to form that picture, which which is on the box. So that putting together of various different structures and having an understanding of what you want the exit to look like is so important. And a good accountant can put together the right structure, the right Lego, to be able to assist you with that exit, and strategically at different times of your life, because life changes and things get in the way. But you can try to take advantage of those different variations that you go through in life, or different changes that may happen financially. And that's where exiting at different times with the right structure can be extremely profitable, especially again with that dollar saved, dollar earned mentality.
Yeah, you touched on it well. Have the end in mind. And I think where I see a lot of people go horribly wrong is they get into a deal because it's easy to get into, but they didn't know how they wanted to exit it in the first place. Do I want to hold it? Do I want to sell it? Do I want to sell some of it and keep some of it? They haven't mapped that out up front. And as a result of that, they don't even know, do I want to exit this as land, or do I want to exit this as a brand new build? They haven't mapped that end journey out because they don't know how they want to get out. It dictates how they actually get in. And so they can actually tie themselves up in a knot. And if you get it wrong up front, it can be very expensive to unravel.
Yeah, and look, again, my experience in this industry over 18 years, Rob, I see it so many times that, like you said earlier, people just jump in. They're so excited to get into it. They just forget to ask all the right questions up the front, and the cost to them at the very end is significant. It's not pennies in the dollar. We're talking about tens of thousands, hundreds of thousands of dollars at the end that could have been mitigated if they just had that really strong business plan at the front. It's not difficult, and the structure that an accountant can create or a solicitor can create for you at the very start, if we get the intention of what you're trying to do right, and we get the strategy up front, we can create the best structure for you. Where things get a little bit hairy is that you may have all intentions to do what you set out, but things do change. And I always make a caveat to all clients that the structure that any professional can create for you will only be as good as the original intention. So sometimes you may have to follow through, but getting that hybrid structure right, or the ability to getting that hybrid structure right, could save you, not in most cases everything, but definitely some of the tax. So it's important to make sure that you've got provisions in place using the right variations of companies or proprietary limited entities, trusts or unit trusts, to make sure that the outcome is favorable but profitable.
Yep. And so you touched on it. Have the conversation. But what are the things that we need to do to prepare ourselves for coming in? Now, I've got 5 questions that I kind of always think about every single time I want to go into a deal. And that helps me to prepare when I want to go and actually get my advice, to make sure that I'm giving the right information to, I guess, the accountant or the solicitor, so that they can give me a fully informed decision. Because if they only have half the information, they can only give you half an answer. And so firstly, question number 1 that I ask myself, what do I want to do? Am I investing, as in long-term buy and hold, or am I developing? Okay. Or am I developing with a view to selling some of them and keeping some? So understanding what that is going to greatly impact the way we. So what are we trying to do? The next one is, how do we intend to exit? And I kind of stole a little bit of my own thunder from that one. Do I want to exit by selling everything, or do I want to keep everything, or do I want to sell some, keep some? Because that could change things significantly. How long do I want to hold my assets? So if I'm going to, hold it for, I think the period is 5 years, then one set of rules apply. And if I'm going to hold it for more than 5 years, a different set of rules start to apply. Then what entity do I want to do it in based on those things? And then lastly, when I actually get the cash, where do I want the cash to go? Do I want that to go to me, to my kids, to my dog? Don't have a dog, by the way. But you get the idea. So when we can actually map that out and go, well, this is where we think that we want to do, then you can actually come and have a quality conversation with someone like yourself.
Yeah, and look, the first point you made is probably one of the most important points. Am I investing or am I developing? And it comes back to the age-old debate of, am I going to be paying capital gain tax, or is there potential GST implications on what I'm doing? So each one of these 5 questions that you're asking yourself to derive a strategy and also a structure, there's significant implications from a tax perspective. And it goes back to what's CGT versus what is GST. So that's first and foremost. My intention of holding, the second point you mentioned, Rob, again, also important. It's how much GST potential I can claim back through the build, or what potential I need to pay back in the long term. The length of time also dictates a cost of GST versus a cost of CGT, and the proceeds, we're skipping at the very end, the proceeds of where they're going to. The tax can be huge, whether it's in your name, significant higher amount of tax if you're at a high marginal rate, maybe no layer of asset protection on that cash, depending what your circumstances are. Or does it go into corporate beneficiaries, or more colloquially known as a bucket company? So those 5 questions that you've actually stated are gold. And if people follow that transition, you're going to get to a very good comprehensive structure that's going to be able to tick off a lot of the things that you need to ultimately be successful in developing property and being a developer in general.
Well, let's break it down, mate. Let's start at the beginning. So you mentioned it, capital gains tax versus GST. So firstly, what is capital gains tax? Let's just start there.
Yeah, so it's a tax that is implied, based upon, and paid when you are investing in an asset. It doesn't have to be just property. It can be any asset where your intention is to make money in the long term via holding it. It's a tax that gets attached to the income of the entity, whether it's a trust, for argument's sake, that distributes it to an individual. But in most cases, it's tax that an individual will pay based on selling an asset for more than what they bought it for. More commonly, capital gain tax, when you're holding those assets for longer than 12 months, will attract a 50% discount, Rob. So that means that you're only really going to be paying tax on 50% of the profit, and the other 50% of the profit gets to stick in your back pocket as tax-free. So it can be quite beneficial for you in the long run, but not understanding if you're an investor holding assets on capital account, meaning you're just there to hold it long term, versus a developer who's there to really turn property over as a stock, which means that you're buying and selling, or buying and moving on. Those 2 differences will attract either capital gain tax with or without a discount, or potentially tax on a revenue basis, which means that you're going to be paying tax at the entity's level, whether it's you personally at 47%, ideally not, versus a corporate entity where it could be 25 or 30%, depending on the passive nature of the entity. One of the big things
we're probably going a little deep, a little early, mate.
I'm sorry. I get too excited about this, but one of the big things.
I'm going to break it down and give them like a real world practical example that might be able to help them to sink in. So if you buy an asset for $1 million and you sell it for $2 million, there's $1 million capital gain. Now, if you did that within 12 months, then you're going to pay the tax on the full $1 million gain. If you own it for more than 12 months, then you're only going to pay tax on 50% of that, which is $500K. Then the next part is, where does that $500K get accounted, and what rate is it actually accounted at? And typically, and that's where you are going to go, is who was actually the owner of that particular entity, that particular asset. Now, if that was you, the human, then that goes on to your income tax. And if you earn 100K a year, that year you now have an additional 500K revenue. You're now at 600K worth of revenue for that particular year. So you've just rocketed to the top of the charts with regards to your tax bracket. Whereas if that was in a corporate entity, then you'd be paying that at the corporate rate. Did I summarize that relatively well?
Absolutely perfect. And the tax can be, there's indirect taxes on top of just paying capital gain tax, especially when investing in your own name. You've got this nasty wealth tax called Division 293, Rob. And that's for people earning over $250,000. And it's a tax based upon the concessional contributions that go into your super fund. So there's a lot of indirect costs that everyone needs to be aware about, and structure becomes very important. But absolutely spot on from a CGT perspective. GST is one of the things, Rob, that so many people just don't understand, and absolutely miss out on their feasibility. So it's important to know that if you are now going down the path of development, your intention is to buy and build and sell, treating property as a business, then you need to factor in that there'll be GST that you get to claim back on the build component, or expenses that have GST built into the cost. Could be architectural fees, could be certain planning fees, could be removal of the property itself, a lot of different things. On the other side, that benefit of claiming the GST back on the costs, you now have to pay GST on the sale. And there's two different schemes that we use. We can have a GST on the full sale, which means 1/11th of what we've sold it for, and it's based upon how we bought the property to determine the end GST result. Or more commonly, for a lot of investors that are developing property and selling, you've got this concept called GST on the margin scheme. And that's doing a very basic calculation of the sale price, less the cost to buy the raw property, excluding stamp duties and solicitors' fees. So again, a really good example is that we've sold the properties for $2 million, and we bought the initial land, for argument's sake, with an old house on it for $1 million. Then that margin is now $1 million. And we will pay GST to the government on that $1 million margin, 1/11th of it, which in this case would be $90,909. So their cost, GST is a genuine cost that you need to factor in, because if you've made money, the GST normally that you pay at the end is more than what you've claimed throughout the build. And therefore that needs to be factored in as a cash outlay going towards the government. And a lot of people don't factor it in and think at the end they're making all this particular amount of money, and they're obviously not. So you need to make sure you're determining your original intention, whether you're an investor or a developer, and that will dictate and determine whether you're going to be paying capital gain tax with or without a discount, or tax on revenue basis, meaning no discount. You pay the tax at the marginal rate of the entity or the person, but you've also got this other little cost attached to it called GST.
Yeah. So the key distinction there is it's an or tax. It's CGT or GST. It's not both. And I see a lot of people out there who think that both will apply, or that they can apply one in one realm and not in the other. And the distinction comes down to whether or not you are carrying on what the ATO deemed to be an enterprise. Now, I'll try to simplify this in human speak. Basically, if you're buying and selling a widget, and so you're buying something, adding some value, and selling that, you're carrying on an enterprise. And so they deem that to be a business, and so GST would actually then apply. Now, in our instance, our widget happens to be property, right? And so the moment you start to do that, you start to trigger that. Now, are there any exceptions to that? Because I hear a number of people go, well, for my very first deal, I can just do this one way. And like, what's the one little loophole that might sit there, and how many times can people plug that loophole, mate?
Yeah, well, it comes back to, again, what was your original intention? We speak about intention. I'll repeat that word many times. But if you've bought this particular property, you may be working full-time in IT, and your husband or wife might be working full-time for, say, a public servant or public service. You've bought your property and you've wanted to build a duplex on it because you identified that particular value. Your intention was to hold it long-term, rent it out. You did do that, maybe rented it out for a year or so. Interest rates got big on you, because we've all seen how quick interest rates went up in the market, and you really couldn't afford to hold it. You've done everything with the intention to be an investor. You have not claimed GST throughout the build. You've maybe rented both of these sides of the duplex out. You've held it, long-term tenants. They've signed 6 or 12-month leases, but we just couldn't afford it. We've got substantiation to show that we're losing money on holding these long term, and the right decision was to sell it because we just couldn't afford to hold it anymore. In some circumstances, the ATO will agree with that, and it's a decision that they make based upon the facts that you present them. But if you've bought a particular property and, for argument's sake, you've got the DA in straight away, and you've spoken to an agent to get pre-sales being done, then it's very clear that your intention, even though it's your first property that you've developed, your intention's very clear. You've bought these to sell and carry on enterprise. So you've really got to take into account the facts of what's going on. Keep documents, or document the whole process. Make it very clear to everybody, anyone who looks at this 10 years from now, so they can understand and read the picture that you've painted. If there's any ambiguities, Rob, in some of these circumstances, they tend not to go in your favour with the ATO.
Yeah, and you've said it clearly, but I'm going to re-articulate it just to be sure. We've given you 5 questions to go have a conversation with your accountant and your solicitor about. Go have those conversations behind a closed door and understand all the permutations of all the things you can and can't do, what may or may not work. And at the end of that, document, this is my intention. Send them a letter and go, right, I've been thinking this through. This is what I want to do. Get that clear and upfront. But then make sure that all of your actions later on actually represent that. So don't counter that. So you're laying a breadcrumb trail later on, so that should something change and things go against you, then your backside is covered.
Spot on. Absolutely spot on. It's easier to paint the picture as you're going than trying to recount it 5 years later when there's an ATO audit, which many people just don't spend the time to do. So intention's important. You need to make it very clear of what you're doing, and your actions, as you mentioned, need to represent that.
Yeah, and equally along those lines, I've seen people try to do a couple of little loopholes where they'll do a development and live in it as a PPR and do that for a period of time, and that as a working example one time works well, right? But if you do that again and again and again, then the ATO looks at your intention retrospectively, and it only takes one audit in 3, 4, 5 years' time, and they go back and retrospectively look at everything that you've actually done, and what you may have got away with many, many years ago suddenly comes back to bite you.
Absolutely. And the ATO go as deep, and I've been in audits before, they go as deep to understand what your profession is. So if you're a builder who, for your argument's sake, has a builder's license, you build people homes, of course, and you build yourself your own duplex to live in one, rent the other side out, and then sell it, they can even go as deep to say that, hey, you're a builder. This is what you've done. This is your business. You've just tried to create some value for yourself, and you're trying to escape behind the principal place of residency exemption. So they take all factors into account, even what you're doing from a profession point of view, to come up with a scope and an opinion of what they believe maybe your intention was. And they tend to not lose often, especially when dealing with mum and dads or people like us without the Google and the LinkedIn and the Amazon budgets.
Yeah, well, and and if you're turning up to meetups that teach you about property development, if you're doing courses that teach you about property development, that sort of thing, and you're showing the intentions that your desire is actually to become a property developer, the first one is likely to be a development, and as such, GST likely to apply. So be very, very, very mindful and cautious of that. So now that we know that's kind of what are we doing? That's question number 1, mate. How do we intend to exit the deal? Now, if from an exit the deal perspective, if you're getting out of Dodge, if you're going to sell everything, then the entity that you do it in, do we want to keep that entity alive, or do we want to kill that entity as quick as humanly possible?
Yeah, most commonly what you'll find, a lot of people will try to kill the entity as quickly as possible. And that's done through ideally liquidation. It's when you're really putting something to rest, you're killing it, it's dead. Very hard, in fact, almost impossible to rise a liquidated entity. So it's important to understand that when you're getting rid of all the assets, you're trying to really clear the slate for anything to come back to that entity or potentially you. So liquidation is a very clear and easy process to do. There is a cost attached to it. A very special accountant called a liquidator does do it. And it's very common in the building industry and the development space. It kills your risk. You're getting all your profits out. You may be passing that through to your hybrid structure that you've created. And that's a really good way, as I said, to put everything to rest. Go to sleep without a wink of opening up an eye throughout the night.
Very good. Okay, what if we intend to hold an asset long term?
So the holding asset of a long term means you can't liquidate the company then. You need, or the entity, for instance, you need to keep that entity alive. And that's where we spoke about earlier around hybrid structures. So whether you're keeping the whole thing, you need to make sure then you're keeping the entity alive, well, you're doing all the tax returns, the financial set of accounts, and that's where maybe a trust might be involved in most circumstances. Really good way to hold things long term. But again, a hybrid model, Rob, that's where you may want to have a look at creating development agreements and having a range of different entities working together where you are getting that tax minimisation aspect of it together with the asset protection aspect too.
Well, this is where, and you kind of stole the punchline, but if you're holding it, folks, from a tax minimization perspective, if you're going to hold it for that long period of time, for that 5 years, and you want to transition this into a long-term hold, then you want to try and take advantage of the fact that eventually that's going to transition away from the GST because you are no longer a developer. You've proven that you're an investor, and you're going to transition from GST over to CGT. At that point, you want to get your capital gains tax discount, right? So the trust can actually do that, whereas another entity, such as a company, might not be able to do that. And so the entity that you actually hold that in is quite important.
Yeah, and I think it's important to note a trust is an entity that must distribute all profits, but does have the ability to pass through a 50% discount to the beneficiary. So tax is paid at the beneficiary's level. Really great way. I generally refer to a trust as an investment entity. Great way to hold things long term. But when we're trading, when we're using property as a form of business, we want to use a trading vehicle, which is more commonly known as a company or proprietary limited entity. So just keep that in the back of your mind. If you're investing long term, trust is a great way to do it. If you're trading property, company, and if there's a possibility of creating a hybrid structure, which in many cases there is, that's where your accountant can really put together a trust and company working with cohesion to get the best outcome for yourself.
Yeah. There is a gotcha in that long-term hold, though. And so we've just described the best tax advantage by having it in that entity. But if that entity did the development, then the asset protection issue becomes an issue because we have that ongoing warranty obligation with that structure that we created. And so the development entity that created it and the entity that is keeping it is now the one and the same, and there's assets still contained within it. So that's when we want to start to break those two things apart and have one entity that does the holding and another entity that does the developing, and have some sort of documentation between the two to say this one's going to take the risk, this one's not. And there's a concept that we should have talked about pre-framing this and didn't, called the person of substance and person of straw, which is the ability to have an entity that does the risky part but holds no assets, and another entity that holds all the assets but takes no risk, and be able to have them as completely separate entities. Now, it's called a person, but it's not a human. It's actually just a concept of an entity that could be any of the structures that we're talking about here.
Absolutely agree. And again, as you start to grow and build bigger things, the asset protection and tax minimisation becomes an important factor. But sometimes what you'll find is once you've built up a bit of wealth, asset protection is key. So making sure that you're understanding your person of substance and person of straw needs to be at the forefront of your mind and fundamental to whatever structure you're creating.
Yeah, and it stops all sorts of things from attacking you. It's not just hey, I've got this one particular development entity. So it might not be this one project. This project might go well. The next project might go really well. The project after that might go really well. All of a sudden, we've got a really great asset base. And then one thing goes wrong. And if your structuring is incorrect, you've got this massive amount of asset that is suddenly exposed. And so being able to silo those and I guess funnel them down into the appropriate holding entities in order to protect that is super important.
Yeah, and also off the back of what you said, Rob, it's very important about what they call contingent liability. So if you're using the same entity, for argument's sake, to carry on multiple developments one after the other, that means you potentially are carrying the risk of the prior development. And if you are quite active and doing it a number of times, all of a sudden you're building up this huge contingent liability from the past developments if you're all doing it in the same entity. And that can become a very dangerous aspect as well. So it's important to make sure wherever you can, you kind of want to silo off what you're doing in various different structures so they're not linked to each other and one card doesn't destroy the whole deck.
Yeah, so in human speak, do one project in one entity, do the next project in a different entity, do the next project in a third entity, and have all of the cash funneled down into a bucket entity that actually keeps it. And then you can redistribute that cash up and reload that as and where appropriate. Not advice, folks, just lessons learned. What have we not covered here, mate? So how long do we want to hold the asset? We touched on this before. The 5-year rule, mate. What's the 5-year rule?
So tax office generally say that, we believe 5 years is enough to show us your intention, whether you're a developer or you're holding property long-term as an investor. So for argument's sake, a very good example is, let's say your intention was to be a developer and you've built a certain amount of properties and you've claimed a whole lot of GST along the way. You've decided that, hey, my intention is now changed. I want to hold this property long-term. I know I've claimed the GST, but I want to hold it long-term. It's a great asset. It's going to make a lot of money in the future. I want to rent them out. ATO says, well, within 5 years, on a pro-rata basis, over each year, you've got to pay us back a portion of the GST that you've claimed. And by doing so, that means that you've, yes, got some benefit of claiming the GST up front, but every year you need to make an election to the tax office that, hey, year one's gone, I haven't sold it, I'm still an investor, I need to pay back 20%. Year 2, 20%. Year 3, 20%. Year 4, 20%. But on year 5, you say, well, I've now decided to sell this particular property. That's when you need to factor in that there's a pro rata of GST now you need to pay to the tax office based upon that 1 out of 5 years. But if you've gone now the whole 5 years, for argument's sake, Rob, and you've paid back all the GST that you've owed the government, then the argument can be said that you have shown very clear intentions you are an investor holding long term, and GST may not be applicable on the sale. So it's very important that if you do decide and you change your intention throughout the process, you need to make sure that you pay back GST that you've claimed along the way. If you sell it within that 5 years, there could be a pro-rata of GST that you need to pay as part of the sale. And it's important that you do nominate that and note that early with the tax office, because if you don't pay back any GST, then they can see the whole thing still as the original intention as being a developer. So hopefully that's clear for everyone. It's a very complicated way of doing things, especially when you start to muddy the waters of being part developer, part investor. But it's important to understand that as that intention changes, there are impacts financially with the tax office that you do need to remediate with them, so you aren't left potentially paying money that you're not expected or not due to pay.
Yeah, these are the breadcrumb trails that we talked about before, with showing not just your intention, but your actions actually match your intention. Now, something popped into my head that we should have mentioned back when we were talking about GST a little bit earlier, and because people are a little bit confused about GST and how it actually works. GST is a pass-through tax. So each particular person, so I'm going to give an example. You'll pay your town planner to do some services, and they will charge you GST. And so there's some GST apportioned to that town planner will then go and pay the ATO. You can now use that GST that you've applied as a credit towards future GST when you go and sell an ultimate project. But when you have GST that you owe, you can then claim that as a credit on the way through. So that has passed through you, I guess, until the ultimate person the ultimate person being the person who buys your property in the end, they're the one who pays the full GST. And in the meantime, it's just been a money shuffle all the way through. And some money goes to the ATO, some money comes back. So it becomes a cash flow challenge, keeping the GST and mapping it out, because you have to pay it out and then claim it back, and then pay it out and then claim it back, until finally you pay it back again.
Yeah, and I think a little bit of I wouldn't call it a positive, but I call it the silver lining of GST is that many developers will use that GST credit they get back as they're lodging their business activity statements as an assistance of cash flow. So there could be interest that they need to pay, or they might be a couple of other costs. The GST that you've paid as a part of the development and every month or every quarter, and I do recommend as a developer, try to get onto a monthly lodgement system. That way you're getting GST back as a credit on a monthly basis as opposed to a quarterly basis. It will assist you a bit better with cash flow. But that will give you an opportunity then to use the GST credit you're getting back, the ATO's money, to be able to assist you to hold some costs or hold the development a little bit easier. Keeping in mind that at the very end, in most circumstances, the purchaser will withhold the GST that you need to pay to the government as what they call a GST property payable credit. And then you will need to submit a BAS at the very end when it is sold or when it settles. So important to note that these are the ins and outs that occur in direct taxes outside of just the end of financial year tax, and how can you best use them to assist you to be able to carry forward and move forward successfully with holding developments.
So, mate, everything you said made absolute sense, but I'm going to break it down into some smaller steps for those who've never done a development or never run a business or anything like that. Okay, so we've determined GST is going to apply because we're going to trade some widgets. Okay, we're running an enterprise, which now, because we're running an enterprise, the ATO says, look, the moment you recognize that you're actually going to be selling something, then you must and you're going to generate more than $75,000 worth of revenue. And let's face it, anytime you sell any property, I have not bought a property for less than 75K in a very, very long period of time. My very first house was 55K, so it has been done.
It's not showing your age there, Rob, is it?
But if you trigger that 75K part, then every quarter you must do what is called a business activity statement. And that business activity statement is measuring how much GST has gone out and how much GST has gone in as an accounting for where the tax has actually gone. And so that is your opportunity to claim back those credits from those consultants that you've paid, where I said before, you paid your town planner, so you can cash flow that into your business. But as I said, it's a pass-through tax. You have to eventually pay that out at the end, but you've been able to use that as a temporary cash flow measure. And when you finally sell the property at the very, very end, then that tax leaves you forever. Now, what you touched on there was, hey, there's an opportunity. Whilst it's compulsory to do every 3 months, there's an opportunity to say, do I want to do that every month instead of every 3 months? And if you do that, then you can get that cash flow in a little bit faster. Now, we need to balance that with, well, actually, there's a cost of doing that from an accounting perspective. And is the cash flow you're going to generate actually worth the... so if you're doing a big project monthly, absolutely, categorically, without doubt. If you're doing your very first project and it's itty bitty and it's there's not much cash flow benefit, you might find that the accounting side of things doesn't weigh up the benefit. So it's really something that you need to have a conversation with your accountant about, to say, hey, based on the kind of project I'm doing, is there an opportunity here to improve my cash flow, or is there is this something where I can just kind of fumble along every 3 months or so?
Absolutely. Cost versus benefit analysis, always key to everything.
Cost benefit analysis. Okay, so what entity do we do it in? We're on to question number 4 now, mate. Now, there are many, many entities out there. So there's you, the human. There's doing it in a company. There's doing it in a trust, or when we say a trust, we're typically talking about a discretionary trust. And so when somebody just uses the word trust, that's typically what they, or a unit trust. So there's all these different entities to choose from. Some of that will come down to what you're trying to do, and some of it will come down to how you're trying to fund it. Because I'm going to say that if you're trying to fund things with traditional residential lending, things like a unit trust will trigger big alarm bells inside the bank going, you are not an investor holding this for 20 or 30 years, but instead you're very clearly a developer. Things like a company might trigger 50% of the banks to actually do that. But a human and a trust tend to not trigger the bank in that residential sense. If you're doing commercial lending, they don't care what structure you're doing it in, so long as the deal's a deal.
Absolutely.
So how you're funding it is just as important as the tax minimisation and the asset protection side of things. Having said that, person, should we do our developments as an individual, mate? Yes or no?
Absolutely not. We should never develop as an individual. The tax implications are too high in most circumstances, and the asset protection risk that you're going to be carrying on potentially for a large number of years, far too great. If we're investing in property, Rob, and we're buying this property as our first investment, holding for long term to ideally get some rental revenue and claim maybe a little bit of expenses to assist with some negative gearing benefits or passive income benefits, more than happy to buy your property in your own name. It's a cheap and simple way to do it. You're holding it on capital account, investing for long-term gains. But if you're going to use property as a form of doing business, very rare circumstances, in fact, none, would I suggest that developing a property in your own name would be suitable. Tax, asset protection, my alarm bells start to ring.
Yeah, I'll put one caveat in there, in my humble opinion, and happy to be challenged here, mate. If you've been investing in your own personal name for quite some time, and you've got a whole bunch of assets in your name, when you go into the development world and you suddenly start to take projects on that start to do risk, you, the human, have a whole bunch of assets that are actually sitting there. So as much as we're talking about an individual project perspective, you want to think about your long-term perspective. You want to think about your entire investment career long-term and go, well, look, if I want to start small as an investor and then maybe transition into a developer and then go on to do bigger and better things, that's something you probably want to declare to your accountant up front and go, hey, long-term, is this going to come back and bite me?
Absolutely. And some professions will dictate and determine if you even invest in your own name. If you're an anesthesiast, for argument's sake, you're dealing with a lot of risk and a little bit too much gas or not enough. You are personally liable. So your profession will sometimes dictate when you invest in your own name versus invest in corporate structure. But for most part, Rob, if you're making 50, 60, 70, 80 grand and you want to get into the property ladder and buy your first home, whether it's your home to live in or maybe your first investment with a future opportunity to live in it, your own name will be suitable for that. But when it comes to developing, you want to then start to think about, well, what is my intention with this property? If I'm holding it long term, Rob, most people will arguably say that you should invest in a discretionary trust, which I agree with. It's a great opportunity to separate your assets into different baskets. So you're getting that layer of asset protection, being in a discretionary trust, which is an entity that you do not own, but you control. It is managed.
Control everything, own nothing.
That's it. Famous saying.
I don't own this mobile phone. I don't own my car. I don't own my house. I own nothing.
And it's an important part to understand that concept of the control versus the own. In most cases, in fact, all cases, a trust must have a trustee, but accountants will always advise you never put yourself as an individual trustee, meaning a manager. You are personally managing the trust because the link can be made between the trust itself and you individually, which means you're almost investing in your own name in most circumstances. So all accountants will advise in most cases that you should have a corporate trustee, or otherwise known more colloquially as a $1 company. And that means if there's anything that goes wrong with the trust, They go up the line to the trustee, which in this particular case is a $1 company, and that entity suffers the perils, which in most cases it will have nothing, so it has nothing to give and therefore potentially nothing to lose. So that's very important. We invest long-term via a discretionary trust with a corporate trustee. There's some substantial tax benefits along with that as well, Rob. It gives us the opportunity to be able to distribute profits in the future to the beneficiaries, as well as distribute profits to corporate beneficiaries, such as companies, or otherwise known as bucket companies, where you can start to hoard profits at fixed locked-in rates at either 25% or 30%, depending on passive income tests. These are special tests that the tax office come up with to pinch a little bit of extra money from us sometimes. So the structure is key. Trust from a holding perspective, an investment perspective, lots of doors you can open to minimize tax through distributing to beneficiaries at lower marginal tax rates, or corporate beneficiaries where you can get a very good fixed rate. And that alone is where you're getting sometimes that 10 to upwards of 22%. I've even seen cases, Rob, where clients have saved 47% because they've been able to distribute to a large number of very close beneficiaries who are not earning any income. And they were able to get about $20,000 to that person and save 47% tax if it was to be distributed into their own name. So big benefits. We're talking big dollars.
Mate, I wholeheartedly concur. I'm trying to think, who was it that Packer that famously said the government doesn't know how to spend their money, so why should I give them too much of it? So tax minimization, but not tax avoidance. That's illegal. But minimizing is absolutely legal.
Absolutely.
Mate, the last one, where is the cash going to end up? Okay. So we didn't really talk about a company.
No, go through a company. So company, again, is, I like to look at a company is when I'm trading in business, I might be trading in property. A trading entity should be a company, a PTY Ltd. And that gives us the opportunity that we can earn the revenue and we pay tax at the rate of the company. In most cases, when you're developing, it would be 25%. So that's fantastic. You're not having to pay a lot of tax. How you own that company, Rob, through the shareholding becomes very important. And this comes back to an earlier comment that I made about hybrid structuring, where you have potentially a discretionary trust, an investment entity, owning the shares of that company. And that allows you to then maybe push the dividends through the trust, and then you can navigate it through the path of structure into a bucket company or a corporate beneficiary, as we mentioned before. And that allows you to liquidate that company if you need to. So when we're trading, developing in property, we ideally want to do that through a company. It's a very moldable structure where you can allow lots of different Legos to be attached to it. It's great for potentially multiple parties coming together. It's got a lot of different uses. And we invest via a trust, as I mentioned before. Bringing them both together gives you a little bit of a hybrid structure, which gives you some really great tax minimization techniques, even with the ability that a company has to quarantine profits or retain them at 25% in most cases.
Yeah. So if I pick on some differences between a company and a trust, a company has shareholders and a very clearly distinguished, this shareholder owns this exact amount of the entity. So when the profits are distributed, it must be in the exact ratio of their shareholdings. If we go to a discretionary trust, however, it's discretionary. That's the point. So we can distribute, this year, we might distribute 100% through to Jeremy, and next year we might distribute 100% through to Rob, or maybe just every year 100% to Rob, because he's a really nice guy. But we can get to choose how we actually do that in order to, at a point in time, as our circumstances change, we can then, choose where that money actually goes. Now, that's one point of difference. The second point of difference is that a trust must distribute the cash at the end of the year. It is compulsory, must get rid of it. Whereas a company can choose, do I want to distribute some of my shareholdings this year, next year? Do I want to hold some? And that sort of thing. So if I was to simplify it, then a company chooses when and a trust chooses where. And so when the money comes down and where, and this is where the hybrid part of it starts to come in to go, well, if we start to join that together, we can have both the when and the where, and then get to control, hey, maybe I want to drip feed my cash. Because if I give an exaggerated example, if I've got 2 projects that finish this year and I'm going to have a whack load of cash this year, but next year I've got no projects, then this year I'll have maximum tax and next year I'll have none. Why wouldn't I want to drip feed that over multiple years? Okay, and then smooth out my my tax returns.
Absolutely.
That when and where starts to become very, very beneficial.
Yeah, and you'll hear accountants talk a lot about dividend streaming, which is, again, that slow drip feeding of the dividends that a company issues to the shareholder, so that the shareholder, when they pay that final amount of tax at the very end, they're hopefully not paying that top rate, being 47%, including Medicare. So tax is a major factor, and don't disregard it, because a dollar saved, it goes back to the comment we made at the very start, a dollar saved is a dollar earned.
Yeah. So when we start to combine all of that together, we've got a fairly good view of hey, we want to get into the right kind of structure based on what do we want to do and how we're going to actually exit the deal, how long we're going to hold the asset, what entity type that we're actually going to do, then where we're going to put the proceeds together. When we put all that together, it might not be one entity. It might be 2, 3, 4 entities that we kind of cram together to get that ultimate view of the world, which might seem like overkill for deal number 1. But if you're taking that big long-term view to go, maybe I don't need all of that day 1, but I want to know the jigsaw puzzle that I'm building, and I might put piece number 1 in today, and I'll put piece number 2 in for the next project, etc. So mapping all of that out.
Yeah, and it goes back to the reference at the very start, which again, it's going to stick with me forever, Rob. Lego. It's I'm sure people have watched Matty Johns when Newcastle won the grand final, and he referenced it, that winning the grand final for the Newcastle Knights was as great as Lego, and structure is exactly the same. I get excited talking about it because there is a substantial benefit when you start bolting on and creating various different structures that interconnect, and that obviously leads to a great result. So you don't need to have a very elaborate large structure to start with. You can set up a very core basis of structure, which may include company trust and a trustee, a corporate trustee that is. And then over time, you can really start to bolt on other trust and trustees, or potentially new companies, SPVs, special purpose vehicles, where we can open up and close down at the end of each development. And that's the beauty of structure and the way that we can create it.
Yeah, the one Lego thing that I will throw out there, if you stand on it, it bloody hurts, mate.
I'm feeling the pain now, mate, as my floor at home at the moment is full of Duplo now. They call it Duplo, and lots of different Lego pieces.
Oh, Duplo's for the kiddies, mate, for the infants. So that's Lego for little hands.
Yeah.
But in the same context, if you use these as Lego bricks and that sort of thing, if you don't go and get the appropriate professional advice, then it is going to hurt when you stand on it and you get it horribly wrong. So with that in mind, mate, for anyone who actually wants to talk to you in particular, we've got a link here that will get into Jeremy's calendar. So guys, this is for those of you who are wanting to do these super advanced kind of things. This is not, hey, I just want to do my basic tax return. This is, hey, I'm trying to go into this property development world. I want to map this journey out. So for those of you who want to do that, go propdev.info/Jeremy, and that will go straight to his calendar where you can actually book something in. Any guidance on anyone wanting to do that, mate? What should they do to prepare other than those 5 questions?
Yeah, I think it's understanding what you really want. Start with the end in mind. If you can really map out and say that I want to become a developer and this is the path that I want to go down, it's understanding, well, what things need to be done quite early. And that's making sure that you've got borrowing capacity in some circumstances if you need to do it on your own. It could be making sure that you've got some great equity or money partners involved as well. I do find a lot of people love to go down with all the excitement down the path of property development, or to know at the very end that they actually don't have access to any capital or cash. So I think understanding and creating that community environment, and I've been to many of the property development network meetings, Rob, that you've hosted here in Sydney, and that sometimes becomes a really great starting point because you've got some really sophisticated, like-minded professionals which are all working for a common goal, doing the same thing that you maybe want to do. So I think getting involved in those type of groups is fantastic. Getting knowledgeable around property development, there is a process of doing it. And I don't want to be too rude when I say this, Rob, but I will. If you've never done a development and you haven't done any courses around development, and you're not understanding or learning from other people's mistakes that you get at, say, for instance, the PDN group, then sometimes you'll find that I will probably arguably say that there's a lot more homework you need to do. Getting yourself educated, you can never have enough education, and getting yourself educated in this space is going to actually be the best investment you make, because it'll be an investment in you not losing money in your first development. So get educated. That's one of the main things. It's not something you wake up out of bed and say, I'm a developer. There is so much to know. This is a rabbit hole of red tape and bureaucracy, and learning from some really good people is going to get you there much quicker.
Mate, well, given that you've given the plug on education, we do have a 12-month education mentoring program that I'm not going to go into here, but I will give a link out there to a free course that we have, which will at least give you, I guess, a little bit of an overview of how to actually become a property developer. You're not going to be a property developer at the end of it, but you'll certainly work out whether or not you want to be one. And if you've gone through that free course and then you still want to step in, we then do have a 12-month education mentoring program that sits behind that. But at minimum, do that free course, do those 5 questions, and then book in with Jeremy. So you've got a lot more context on what you're actually trying to do. Lay the foundations right, and then you can actually go from there. Mate, as you touched on, you have been to a couple of our events, but not only have you been there, you've actually been on stage a couple of times for us. So for anyone who wants to come to our events, we run these all the way around the country. We run them in Brisbane, Sydney, Melbourne, and Adelaide. You can turn up physically to do those. But you can also live stream them from no matter where you are in the country, which means that we are pretty much running an event most weekends of the year. As a matter of fact, we run 45 of these events a year. It is just non-stop property and property development, mate. So for those of you who want to learn, it would be great to do that. Mate, any parting words of wisdom you'd like to say before we say goodbye to everyone?
I will say one last thing. Intention's important. Make sure that your intention's very clear, because the structure that you go in is only as good as the intention that you have. So that's probably the last comment I'll leave you with, and probably one of the most important ones out of today.
Mate, it's been a pleasure, and I'm going to see you at one of our upcoming meetups. By the way, it's our 12th birthday, any tick of the clock, folks, so make sure you come to that, because there's going to be parties, cakes, and alcohol and all sorts of things, so come and enjoy. Till then, folks, I'm going to say bye for now.